With everything that is going on in the world today, and considering that gold's price has reached an all-time high yet again and again and again, well, it seems rather apparent that you can't go wrong with gold. Or can you? Yes, you can, and I'll explain why in this video as we explore. At this point, gold seems unstoppable. In overnight trading, gold continuing to climb, now above $3,350 an ounce as I record this video. But that does not mean that it can't come back down. And that's really the subject of what I'm going to be talking about here, because with all the euphoria in the gold market right now, it's only a matter of time before something changes. I'm going to be referencing a piece here from the street by an author here, Luis Linus, that gives us some insight as to why he feels that we're going to see it move in the opposite direction, and why he is actually trimming his positions rather than adding to them now with gold surging the way it is. He's not abandoning gold, but they're the types of moves where smart investors start watching the market closely. And I'm watching the market too, and I'm debating whether or not to continue buying 1 ounce pieces. There are some pieces that I want to buy in order to add to the collection, but I don't think I'm going to be buying gold bars anytime soon. Let's put it to you that way, where the price is right now. But nonetheless, I'm happy with the purchases that I've made, where they were a lot less than they are now. Of course, we can ride high on the horse of a see, I told you so, gold's going up. But you know, many of us feel that even if gold were to drop from the times we made our purchase, that the fundamentals remain the same for gold as a wealth preservation device. And I strongly feel that, because one thing we know, the dollar is a losing proposition. Even though it is money that is a store of value that is draining year after year. That's called inflation. Even if it goes back to 2%, we know it happens. But you know, in this point in time, where we're looking at gold and the price moves in one direction or another wildly, you know, your buying should be a little bit more strategic right now. My friends at Summit Metals have some really good deals on fractional gold right now, and I think that's an area that I may start to focus in as these prices keep climbing, especially as rapidly as they are, if I'm going to be buying any time. But there's a time to buy and a time not to buy. And so it may be a while. We'll see. But nonetheless, Summit Metals is my go-to place. They are the sponsor of the channel. But I would encourage you to consider them as you're shopping around for the best deal out there. And just add them to your list of bullion dealers to keep an eye on. Elevate your wealth with Summit Metals. Back in September, the author here wrote a piece called, "Is the Recent Rise in Gold a Trap?" At the time, he laid out a case for a strong rally in gold, and it looks like that happened. He put forward an aggressive target at the time of $4,600 per ounce. Of course, back in September 2024, that sounded crazy. Now it doesn't sound so crazy, does it? That call was based off of historic rally patterns, inflation-adjusted valuation metrics, and macroeconomic tailwinds. So you look at these technical analysis points, and a lot of people can really play with those numbers and look at the patterns that are put into play, and they make educated guesses on where they think the market is going to go. And I respect that for sure. But nonetheless, all of that flies in the face of fear, which drives a lot of market activity. And I think that's part of what is driving gold's price right now, buoyed up by central bank buying, which again is operated and motivated by fear. But with gold having surged significantly since he wrote that piece, now 70% of that upside target has been reached, he thinks it's time to trim exposure for himself. And this isn't a call to exit gold entirely, but if you've benefited from the rally, this is a prudent time to take partial profits, perhaps trimming 30% of your position, and reassess the risk-reward setup. So yes, he's saying maybe it's a good time to sell. And you know what? I'm one of those people that really doesn't entertain that possibility or chance, but if there is some strategic play that I could make, I may even consider selling as this price keeps climbing up. I don't know. We'll see. It just depends on what that move is going to be like and what could be involved in it. But I'm more open-minded to selling now than I have been ever before. And that's gold. And I wouldn't, even last week, I probably would not have entertained this idea. Now, does that mean I'd sell all of my stack? No. But nonetheless, because I don't want to fall into that trap either. What kind of trap is it? Well, we'll get to that in a moment. So the gold rally that we saw starting back in September, last year it looked relatively cheap when adjusted for inflation. Historic analogs showed that similar uptrends had the potential to reach levels around $4,600. These rallies weren't short-lived. They unfolded over extended time frames and were driven by structural tailwinds, many of which are still in place today. So what do we have working for us now? We've got exploding federal deficits, elevated geopolitical risk. And there's an asterisk on the exploding federal deficits because I think DOGE is trying to rein in some of that spending. But nonetheless, there's still a lot of spending going on in Washington. We also have a weakening U.S. dollar, and that is something we're trading around the 100 range, falling a little bit below that. Some of that is purposeful. We also have surging demand for hard assets as fiat uncertainty rises. And it's not just gold either. It's other commodities, especially with regards to fear around tariffs. So we're talking lead, zinc, iron, copper, and all of that stuff. And a lot of those commodities have gone up. Copper has reached an all-time high recently as well. And then the reemergence of tariffs as a central economic policy tool. Of course, that reemergence has not been at this scale since about 1898 and 1900 when William McKinley was president of these United States of America. We now find ourselves in a situation where gold has attracted strong volume. Momentum has just begun to turn exponential, and micro catalysts continue to build. But these are exactly the types of moves where smart investors start watching the market closely for trimming. And he uses that term investor. But I would extend that to the stacker as well in the physical form. You may be able to take profits strategically in order to make moves in other areas. For instance, if you bought a gold coin, let's just say, and I'm trying to find a piece here that I may have bought where it was much lower in price. Let's just say this piece here, okay? This is from 2022. But you could go back even further. I've got some gold where I paid $1,500 an ounce, $1,200 an ounce for, and you've doubled your money. Well, you could take that and put it towards your mortgage and really bring down your interest. Take all that money and apply it towards the principal. If you apply it towards the principal of your mortgage, that is going to dramatically reduce your interest rate, especially if you got a loan where the interest rates are north of 6 and 7%. That's a dramatic and huge impact of savings from your profits from gold. Because gold is far surpassing as a hedge against inflation right now. It's outperforming a lot of things at this moment in time. It's basically acting like Bitcoin did on its meteoric rise on a little bit of a smaller scale, but I digress. So it's a situation where gold is attracting volume, and there's a lot of buying of gold right now. There's some selling as well. But gold could go parabolic, and then boom, snap. Gold is still in play. The long-term case remains intact. That has not changed. The fundamentals for gold remain intact for sure. I firmly believe that. As a wealth preservation device, but something's going to come back to stabilization. What does that mean? I think it means that essentially we're going to see consolidation, strong consolidation in gold. Because some people feel it could be overvalued right now. It's often a sign here that we see when price action turns parabolic, that short to intermediate term speculative top could be forming. And he believes that we're at the beginning stages of the arc to move in that direction. in this type of move, so staying and the trades continues to make sense. The current leg higher has been fueled by increased instability. And that's really the key here. Instability drives fear, and fear drives chaos in the markets, and meteoric rises in certain asset classes could occur. And right now, gold is at the center of it. And silver could, by the way, also be affected by this down the road. Rising debt servicing costs with treasury yields elevated and debt rollover looming, the U.S. government's financing costs are ballooning, which could continue to hurt the U.S. dollar. Then, of course, we have the tariffs and the trade wars that are affecting the immediacy of the market reactions. The aggressive use of tariffs could continue to drive capital into safe haven assets like gold. Then we have no clear path to fiscal responsibility. Unless meaningful spending cuts materialize, deficits will likely continue to spiral. And right now, nobody, including the Republican Congress, is doing anything about cutting spending based off of appropriation measures in the House of Representatives and in the Senate. They all call for it, even with Doge in effect. So there's still problems there. These forces have driven gold higher, and they could push it much higher still. But they also raise the risk of a blow-off top followed by sharp retracement. In other words, a massive fall in price. Maybe even a flash crash or 2 or 7, especially as analysts and economists move forecasts towards a recession. As of the April 9th, the Atlanta Fed's GDP model is forecasting a negative 2.4% real GDP contraction for the first quarter of this year, which is seasonally adjusted annual rate. A separate model adjusting for gold imports and exports pegs the figure closer to negative 0.3, but either way, momentum is clearly decelerating. So meanwhile, recession odds are rising across major forecasters, and ranging from anywhere between 30 to 35% from S&P Global to north of 60% from J.P. Morgan, and anywhere in between there. The growing consensus, the U.S. economy is losing steam, and markets are responding accordingly. And so that is why he thinks that it may not be a bad idea to consider trimming some of your positions in the market, and also prepare for a possible parabolic move in the opposite direction. So don't fall for the trap that the gold is going to continue to climb and climb and climb. And you see these forecasts that right now don't seem so crazy, but until we see a top and then it falls, they're going to become very crazy again. So watch out, be forewarned, and take advantage of the situation, but hold fast and hold true to your core stack and what gold has been for thousands of years. Don't oversell gold to yourself as well as what others tell you about what gold could do or could go to. It's a little word of warning there for you. I like to bring you discussions like this and love to hear your thoughts as well about them. If you enjoy what I do here, I hope you will consider subscribing to the channel and pressing that thumbs up button down below. With that, I'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.